Good morning, Jags. This is Fahad. Today is Thursday, September 24th. Let's get started. Okay, so I want to start off with an overall view of the market real quick, and then I have one stock. Taking a look at the S&P real quick. As you may notice, the way market rolled over yesterday with a big bearish engulfing candle and on rising volume, the S&P basically was smacked down to a what was a very important VOP support level, and that level is right here around 3220. And if you simply draw the line in the S&P futures, you will see what I mean. So right over here, basically we completed a retest of the prior breakout level, which was right here on 3220, big heavy volume, and we got smacked down to that. Here's the thing, ordinarily speaking, this would basically be a bounce zone, right? And that this would still be expected to be a bounce zone from here. But just be mindful that this market is on the edge because of lots and lots of headline risks that continue to pile on top of each other. First of all, we are in an information vacuum right now because it's the month of September, late in September. We don't have earnings cycle in play right now. And then also we are continuing to see rise of COVID-19 cases, election risk, SCOTUS spectacle, and a whole bunch of other things that are coming into play. So this market is not really reacting to any individual reports or stocks per se. It's reacting to more headline risk. That's what happens in information vacuum. So that's the first thing to keep in mind. And the second thing is that in terms of bounce zone, if we are going to bounce back from here, which right now looking at the equity futures, that doesn't seem like going to be the case because the S&P futures are down once again by more than 12 points. But I just want to point out that market internals are starting to get a bit oversold here. So here is NYMO oscillator that closed at minus 79 yesterday. And you know that this is oversold. We have talked about this multiple times. The thing is that while this thing is oversold, this is also at a level where the extreme levels of sell-offs can actually happen, meaning that in a healthy market that pulls back on light volume and continues to march higher over time, these kind of pullbacks with NYMO getting oversold usually ends up becoming buying opportunities. Is it different this time because we got so many headline risks coming in? That's where the cushion is. Put it differently, when the extent or the intensity of sell-off that usually happens when NYMO is going from, let's say, zero line to minus 20 is far less and in terms of its intensity than, let's say, NYMO going from minus 60 to minus 80, or NYMO going from minus 80 to minus 100, because by that time the market is rolling over materially, and the internals underneath is just continuously under heavy pressure. Yesterday we had an 86% down day in the market. And so these are the kind of elements that you have to keep in mind. I'm hopeful that the S&P is going to start stabilizing right around here. This is major VOP support level. This is the retest of the prior breakout level, and NYMO getting oversold over here. I think we could start to see some fresh buying, but just keep in mind that we're not driven by right now with any kind of a specific news on single stocks that are seen as very positive, except Nike maybe, which didn't really even do anything for the broader market. But it's mostly headline risk, and we seem to cannot get out of that gutter. Every single day it's the same thing. COVID, it's election risk, it's this and that, all kinds of headline risk. Now, with that said, I do have one stock I want to quickly touch upon, which is ZNGA. Now, this has been on my watch list for quite some time. For a potential entry. The stock has been consistently pulling back, but I've been waiting for a potential entry to go long January call options on a technical momentum improvement, and then also any kind of news flow that would give me some comfort that we're going to see some normalization and some excitement coming back into this stock. So purely from a technical standpoint, we started to see a little bit of outperformance with a technical breakout through this downtrending resistance. And if you look at the MACD line, here's the bull cross in MACD line, which is the first bull cross really in several months. And take a look at the RSI. RSI lifted higher sharply, and if you draw the lines and connect the dots, you will see RSI is also starting to give a bull cross. Will this momentum continue in ZNGA? Could it gradually get back from right now, close at 870? Could it get back to $9.50 or $10 per share? It doesn't even have to go all the way back to new 52-week high, but on a percentage basis, if this goes to 9.50 or 10 in that range, you're still talking about 20% move in stock from here. And then 20% move in his stock over the course of next couple months, and you go out to January, and suddenly you realize that these call options right at the money, or even December at the money call options, are actually rather cheap. That can make pretty good amount of money. The reason why I bring this up is because there's an alert out from KeyBank analyst yesterday who talked about that Harry Potter Puzzles and Spells. This is a new game. It's launching today globally. Specifically, Zynga announced a global launch of Harry Potter Puzzles and Spells. This is a free-to-play match-3 mobile game licensed from Warner Brothers. This is the first of 3 games in the near-term pipeline from Zynga, the other 2 being Farmville 3 and Puzzle Combat, which we expect at least one to launch in the fourth quarter, and the other potentially in early 2021. This game was reportedly produced by Zynga core team in San Francisco with one of the larger production teams in recent memory, and the game's early reviews are positive on the depth of gameplay and the meta features. We are bullish on the potential of this game and believe it has strong potential to be Zynga's next forever franchise, $100+ million in bookings, and a material contributor to 2021 results. We currently expect $84 million in bookings next year, though reaching $100 million in 2021 is within reason given the prominence of the brand and proven genre core mechanic. In other words, they're expecting that this particular product launch, this game alone, is going to increase the total bookings by at least 19% to 20% year over year, with the launch happening now and then providing full contribution into fiscal year 2021. If market gets a hint of this and we start to see some more constructive analyst commentaries around it, with particularly 2 more games coming, 3 total between now and early 2021, then we could see this stock gradually start to break out. So that's my quick short-term view on this one, just a high-level view, but understand that this market is on the edge right now. We're sitting at major important support levels in the S&P, and as well as NYMO oversold, but at a dangerous level at minus 80 right now. That's it from me. Jay?
Morning, Fad. Taking a bearish look at Acuity Brands, ticker AYI. This company, for those that do not know, provides lighting and control products. So recessed lighting, surface lighting, suspended lighting. Back in Q3, or for their Q3 earnings report, and this was a few months ago now, in terms of sales across all their channels, sales were down 10+% across the board. Independent sales network was down 10%. Their direct sales network channel was down 31%. Retail sales down 18%, and then sales for their corporate accounts was down 59%. Now, fast forward to yesterday, Robert W. Baird was out with a lighting survey for Q4. And note that the company is going to be reporting their earnings 2 weeks from today on October 8th before the market opens. So going back to the survey that Baird did, this was comprised of input from 22 domestic lighting agents and distributors that represent annualized revenue of $500 million or more, and nearly half of the respondents represent Acuity Brands. And the takeaways were that overall lighting volume was down 9% year over year in Q4, and by verticals, commercial and institutional remain soft. Now, some of the anecdotes that the survey provided, let me just read a few of them to you. Quote unquote, there are a lot fewer specifications for new projects, and existing projects are being bid at lower margins. We have seen a lot of project backlog being eaten up in Q3, and that is slowing in August will translate into a sluggish Q4. New projects are smaller in size than what we had been accustomed to. Slow moving projects are putting the squeeze on revenue. So needless to say, anecdotes suggest continued slowness in project activity. And then the outlook into 2021 also appears uncertain, with respondents projecting a flattish market. So Robert W. Baird believes that based on soft non-residential leading indicators, the bias for 2021 could be even lower.
Yeah, and that was my question going to be, because I think that on a year-over-year basis, there is no question that coming out from the COVID disruption and meltdown in a lot of business conditions in March and basically in the second quarter, as well as partly in the third quarter, I think there's a lot of companies we can still identify in the market that are going to still produce negative year-over-year growth rate, whether they're based on channel checks or management's own commentary for the fourth quarter. But the important thing is not the absolute number of year-over-year growth rate, but whether sequentially improvement that we saw coming out of March has basically come to a halt in some of these cases where you're no longer seeing them accelerate further towards an inflection point of positive growth, but rather when something is down, let's say 30%, and now is expected to be down 10% in the fourth quarter, but then sequentially from this point on, is it flatlining or getting worse once again going into 2021? And that's basically the driver for the stock, and sounds like that from these commentary that 2021 is likely going to be worse again and may potentially get sequentially bad from Q3 to Q4 and then Q4 to 2021. Naturally, that means that the stock will get clipped, most likely, as the analysts will have to go back to their reopening book and have to rework the models. Purely technically speaking, the bear case looks fantastic because this broke down through a major VOP support level yesterday through 98. And the floodgates are open all the way down to about $88 to $89 per share, where the next support comes in. So on a percentage basis, it's easily a 10% decline that we could expect in this stock. Doesn't have to crash and burn, but that's significant enough that somebody wants to step into put options can easily play that move down to 88 over the course of next coming weeks. Great stuff. Chronicle.
Morning. On Acuity, I would also add that the company has a lot of exposure to office buildings. And honestly, even if we have a reopening, nobody's going to be building offices anytime soon. So, but today I have a bearish case on Westpac Bank, symbol WBK. This is a very well-known Australian bank, and they have made a lot of headlines recently because of money laundering scandals, and which came to light last year. But if we're being honest, this has really been an open secret in the country for many years now. So first off, because of this money laundering scandal, an announcement came out this week that Westpac is going to have to pay a $1.3 billion Aussie dollar fine. And in anticipation of that, the bank had already cut their dividend, and after they cut their dividend, they suspended it. And so frankly, the market had already priced this in, and hence the decline. Instead, what I think the market has yet to price in is macro and interest rate related. And so I have some slides here showing some charts that are going to be highly important going into year end. So on this first slide, if you've been following Australian business news, you'll know that the odds of an RBA October rate cut have suddenly shot up this week, and the Australian 3-year bond yield has been moving quickly to price in a 15 basis point rate cut to what would be a record low 0.1% interest rate. So this current window presents an opportunity, I think, to position for the rumor and then sell the fact before the rate cut announcement happens. Obviously, rate cuts have direct implications for bank net interest margins. It's the reason why I don't like owning banks globally. But coming back to Australian interest rates, judging by the 10-year yield, which continues to drop, the market is not expecting this rate outlook to improve anytime soon. And on a related note, there's this image I shared here, which shows Australian bank borrowing rates remaining below cash rates. So what's the point of lending? So this is bear case number one. And on the second slide, before we touch on this next point, it's important to know that residential properties and housing represents 70% of Westpac's loan book. And right now, residential building permits are falling off a cliff if we look at this chart. And then going to slide number 3, meanwhile, delinquencies are shooting up while household debt to income is almost close to 2 times. Next slide. Westpac took $2.2 billion in impairments and $1.4 billion in provisions for the first half of the year. And judging by forward earnings estimates, I get the sense that consensus is expecting an improvement for the second half. But I think it gets worse because it's not likely we see higher delinquencies and yet lower provisions. And I think dividends are going to remain suspended for at least a couple more quarters. So this could be the next shock. Last thing on the final slide, consumer sentiment remains well below contraction and down under. Consumption is down and looks like we're starting to see another saving cycle. So coming back to the chart, I like the short here with a tight stop and targeting between 950 to 10, and then I'm out. Because after that, I think we see at least a near-term bounce because consensus is still extremely optimistic with their 2021 estimates, and there's no catalyst until earnings to prove them wrong.
A short that takes you from 1140 to about 950, your target is easy 20 to 20% return on that short. And given the breakdown in momentum and the absolute disaster performance that we are seeing from the banking sector, overall, whether it's in Europe or United States or now Australian discussion, or even we are already short a couple stocks in South America as well, as Credit Corp and Banco de Chile and all of those. This entire sector just continues to be just a toxic asset, a toxic sector to touch basically, and you have my endorsement, absolutely, considering the bear case that is just presented over here and the technical picture that's emerged in front of us. I wonder though, because the most important point I think that caught on your attention was the point where the cash interest is below the rate of returns, the desired rate of return. So what's the point of lending at all? And that's the problem with falling interest rate environment globally everywhere. It's funny because only the actual guys that are on the street that are actually making the lending activity happen would get to see this view. So otherwise it's so difficult for the market participants to absorb this. Declining interest rate is not necessarily bullish for banks. It's actually quite bearish because it cripples their net interest margin, a view that I presented so many times across the United States in so many different stocks and such. So going back to your chart, easy 20% potentially to the downside coming, given the technical picture here as well. I might jump into the short myself, considering I already followed you and myself into some of the other banking shorts in recent months that have done quite well. Great stuff. Thank you for joining, and that's it from us. We'll see you in the chat room shortly. Most important thing I'll tell you is watch the support in the S&P around 3,200 level. That's a major VOP support, and NYMO is oversold, closing at -79 yesterday. That's it from me. See you soon.